So, as everyone expected, the Fed finally slowed down rate hikes to 50 basis points after raising rates fast and furious during the last few meetings. In this video, I'll be going through what Powell said, what this means for the stock markets, and what you should do now. Alright, let's start with the CPI report that came out earlier this week. In the report, it shows that the inflation rate from a year ago came in at 7.1%. This is super good news because it now clearly shows that the inflation rate has indeed been coming down. And if you look at the month-over-month inflation rate, it has also slowed down to 0.1%. Looking at the breakdown, we can see that inflation for most of the categories have also been slowing down. Food inflation slowing down, energy prices declining, both new vehicles and used cars inflation are slowing down. Medical care services are also slowing down. The only thing that's remained stubbornly high is shelter, which makes up about 1/3 of the CPI. But if you take a look at what's happening in the real world, it is telling a totally different story. US renters have been falling, occupancy rates falling, home sales falling, single family construction has also been falling. Basically, you get a fall, everyone gets a fall. But why has the shelter cost not come down yet? Basically, lag. Due to how the data is collected for shelter costs are estimated to be lagging around 12 months. So, we will only start seeing shelter costs come down by the middle of next year. So, if inflation is cooling down now, that means that the Fed can start cutting rates. Hold up, we can't do that yet because even though the inflation rate is slowing down, it is still very far from the 2% target. And if the Fed were to listen to Elon Musk and start cutting rates, you will see inflation immediately U-turn and go back up, like what happened during the 1980s, and that will be super bad. So the Fed will have to keep raising rates, though at a slower pace. But as to how high the rates will go, here are their projections. In the previous estimate in September, the Fed was originally planning to raise rates to 5%, but now most of them think that the rates should be raised higher to around 5.1%. And they are not planning to reduce rates until 2024. When this news broke out, the market be like, crash ah! Okay lah, it's not a crash, it's just a mini drop. So if the Fed were to follow up with their plan, we might see them raising rates all the way to either March or May, keep rates high for a while, then only start reducing rates in 2024. But interestingly enough, the market be like, I don't believe you. Currently, the market is predicting that the rates could come down as early as September next year. So, we will have to see what happens then. But of course, all this will entirely depend on the CPI report that's coming out over the next few months. If inflation is really coming down, then we will see the Fed start cutting rates earlier. Quick pause, just in case you do not know already, the Moomoo Singapore app has quite a few useful features. First, they let you stay updated on your favorite stock news. Then, at the financial section, you will see some really useful financial information. Like for Apple, you can see what's their revenue breakdown, how many iPhones they shipped last quarter, the ratios, and all the financial stuff that you need. And right now, the Moomoo Cash Plus is giving a guaranteed 5% yield. So if you put in $10,000, you will earn $123 over 3 months. And the more friends you invite, the more rewards that you will get. Best of all, there's no lock-in period and you are free to redeem anytime you want. So if you are interested, you can sign up to Moomoo and enjoy all their features along with all the free sign-up rewards. And with that being said, let's get back to the video. Okay, let's talk about the next big thing that's on everyone's mind. Recession. Currently, the Fed is predicting that the GDP will remain at 0.5%, which they revised down from the previous 1.2%, which means that they are also getting a little bearish now. But here's the thing, no one can agree whether the recession will come or not. Goldman Sachs thinks that there will only be a 35% chance of recession. The Fed believes that the chance is slightly higher at 50%. Wall Street Journal survey estimates a 65% chance. Vanguard sees a 90% chance. Basically, no one is sure. Personally, I believe a recession will likely happen, especially when I see that the 10-year, 2-year yield curve looks like it's trying to go 18 feet underground. So, what does this mean for the stock market? in the latest quarter's earnings, it was found that 70% of the companies were still able to beat earnings, while analysts are still expecting a positive earnings growth of 4.4% in the upcoming quarter. In simple terms, the market hasn't really priced in a recession yet. So let's say if a recession did come, how would the market actually look like? According to BlackRock, even though the market has fallen almost 16% this year, they still feel that equity valuations have not truly reflected the damage ahead. If you look at the S&P 500 PE ratio, even though it has fell all the way from 35 to 19 now, the current PE ratio is still quite high. Historically, during recessions, the S&P 500 tends to bottom only at the 12 PE ratio, while dropping anywhere from negative 14% to negative 57%, with an average drop of negative 32%. The only recession where the market didn't drop was during the 1945 recession, where the market be like, crash what crash? Crash your head and went up instead. So even though the S&P 500 has already dropped by quite a bit, statistically speaking, the market can boom even more. Okay, enough of scaring you. Here's some good news. First, no one knows whether a recession will come or not. But a large majority of economists say that even if a recession comes, it will be a shallow recession. That's because right now, the unemployment rate is still quite low. And the Fed is only projecting that the unemployment rate to only go up to 4.6%, which is quite mild when compared to past recessions. And according to JP Morgan, by 2024, when things recover, the US economy may look similar to late 2010s. Slow growth, low inflation, moderate interest rates, and strong corporate margins. Second good news, we don't have to wait long for the market to start going back up, because historically, the market tends to bottom during recessions, typically within 8 months or 5 months if we exclude the 2 worst recessions in history. The worst period to be in is not during a recession, but rather 6 to 12 months before the recession comes, which is like right now, because that's when the market gives a negative return 55% of the time. Then, just after 6 months into a recession, we could already see positive returns 82% of the time. And the longer the period after the recession, the higher the average return. So now, what should investors do? Cry lor? Just kidding. My suggestion is as usual, continue to dollar cost average in. Market up, you buy. Market down, you cry, then you buy more. That's because it's almost impossible to time the market unless you are hardcore. The S&P 500 usually reach the bottom first 8 to 9 months before earnings per share reach the bottom. So by the time you hear any good news, the markets would have already gone back up. Remember, you don't have to buy at the cheapest. You just have to buy when it's cheap. Besides that, don't just leave your money lying around doing nothing. Park it somewhere that gives you a high interest. It can be in high yield savings account like the UOB one that's giving about 3.8% interest now, or in brokers to earn some returns on your funds, like Tiger Brokers, which gives 4.1% interest, Mumu, which gives 4.1% interest, IBKR, which gives 1.4% interest, and Poems, which gives 2.8% interest. Personally, I wouldn't recommend parking in T-bills, even though it's currently giving over 4% now, as you can only get back your money after 6 months, and it's hard to sell your T-bills early. There are also many other ways to hedge your portfolio, like using TLT ETF, or playing with inverse ETF, or doing option strategies. But unless you are some pro investor, I suggest you don't go and touch those stuff, yeah. Later you get burned, then you know. In short, just continue to DCA and believe that over the long term, the market will continue to go back up because stonks. Anyway, that's all for this video. Hopefully, you find it useful. Like, share, and subscribe as I'll be hosting new videos every Monday, Wednesday, and Friday.